Exactly what we're diving into today. If you need to have a startup business, you're trying to launch it, you need to get the money to get the business off the ground and get it through its initial stages till you start getting to the growth stage. How do you do it? That's exactly what we're going to decode during today's training. Throughout this, you're going to learn the kind of steps to set yourself up to be able to get financing in the early stages of your business to be able to get to sustainable success. So look, if you're thinking about starting a business but it looks daunting, you're definitely right. There's a lot of work to be done, right? There's a lot to think about, in particular, how you're going to get the money to fund the business. Here's what I've learned along the way. A lot of experienced entrepreneurs learn the same thing. It takes oftentimes twice as long and twice as much than you think it's going to take. As a matter of fact, even after being an entrepreneur now for well over, I don't know, going on 20 years, I can tell you that when I find my absolute best assessment of how long something will take, I still double the expected time frame. And then I also do the same thing with how much something is going to cost. And when you start a business, sometimes it can be 2, 3, 4, 5 times more than you initially expect that it will cost to launch. And the other problem is it takes way longer than you typically think to start generating the revenues and the profits. So how do you get yourself to a point where you are financially sustainable? Well, that's exactly what we're going to put together today, because about half of all businesses that do fail do so in the first 5 years. And the number one reason, well, they just ran out of money. 4 out of 10 nearly of those businesses, that's the exact reason that they cite. Now, the interesting thing is, if you look at statistics here of business failures, what you see is that even though about 40% directly say we don't have money, that's why we're failing, the others statistically fail for reasons like mistakes that the owner makes. And the way I look at it is that money solves the top 3 reasons that businesses typically fail, because if you make mistakes as an entrepreneur, which we all do, and you have enough capital on hand, well, then you can recover from those mistakes. But the problem is that when you make costly mistakes in the beginning stages of a business, which we all do, and you don't have the money to pull you through, that is when you typically see businesses fail. And an example of this is Twitter. If you look at Twitter, Twitter's been losing money, losing users. They've been having a lot of problems for a long time, but they have enough cash on hand to get them to 110 years of this. Most businesses can't get through 110 days with the capital that they have on hand. So again, having access to money really helps you overcome the biggest reasons any business fails, especially considering the number one and majority of business owners say, look, we just don't have the money. And that's the problem we've got to print. That's the problem we have to solve. Now, this applied to 38% of all respondents to a 2021 CB Insight survey. So this isn't aged data. This is as of last year, where we're seeing that nearly 4 out of 10 business owners just say, look, we had to close our doors. We went out of business. We just didn't have the money to even try to continue. So there's no question that access to capital is vital for survivability, let alone sustainability. And so how are you actually going to set your business up where you're able to get capital? Well, in the beginning stages of the business, this is really the most important part. You have to be appealing to lenders. You have to be appealing to credit issuers. You have to set your business up where they want to give you money. And I've done this for the last 20 years on the consumer and commercial side. And this has been my specialty, is taking a hard to finance individuals on the consumer side, everything from cars to mortgages to regular loans, and business side as well, all types of business financing. How do you take borrowers who are underserved, who aren't typically able to get approved, and create a case where they can get money? It's really what I've spent the last 20 years learning. And what I've learned is that the picture you paint to a lender and credit issuer is worth maybe 1,000,000 words. And what I mean by that, and I'll give you a simple example, you more than likely are here and have heard of something called an FHA mortgage. Well, FHA mortgages are very popular because you can get into them when your credit's not that good. And you put very little money down, 3%. Now, I know this is consumer financing, but I want to give you an example of what I'm talking about. So with FHA mortgages, these deals typically get done what's called an LOX, a letter of explanation. And I've helped, I don't know, hundreds of people get into home loans by writing really, really good letters of explanation. And those letters of explanation say, look, let's start with the elephant in the room. I messed up. This is what caused problems with my credit. I own that. I had issues. I'm working on recovery. Here's what I've done since. And it paints a picture for the actual lender that says, look, I take ownership and accountability. I had problems. Here's what I've done to recover from those problems. Here's what I'm doing now, and proof that I have that I'm financially reasonable to handle a mortgage. And I've gotten so good at writing those letters that I could take some of the most difficult situations and still convince lenders that they should give this borrower a shot. And so it just goes to show the power in consumer and commercial financing of painting the right picture to the lender. And that's really what fundability is, right? Is it helps you get the money, and it helps you basically at the same time attract better customers, because how you structure your business is your credibility. It's your credibility to customers, clients, leads, competitors, but it's also your credibility to lenders and credit issuers as well. Okay. It helps you better run your business when it's done correctly. And it also goes a long way to painting a picture to lenders and credit issuers that you're responsible enough to be given money. And the other part of fundability that has to do with that is business credit building. Business credit building is where we show lenders and credit issuers the business is responsible, the business can pay its bills. And it's one of the biggest secrets I find of entrepreneurship, because a lot of business owners start businesses and their credit is rocky because they're risk takers. They took risks to get to that point. And so then they struggle to get money because lenders are judging them based on those past struggles. But here's what's cool. You only have one legal way in the United States of just poof, creating a new credit profile. And that's when you create a business. When you create a business, it's a blank canvas. You literally can start from scratch building a credit profile and score for that business. And the credit profile and score is literally used by lenders and credit issuers to depict the risk of lending money to the business. It's the risk that the lender has or the business has of paying or not paying its bills. And so what happens is when we establish this credit profile, when we establish this credit score for the business, it goes a long way to establishing a reputation for our business that it is responsible. Now, the banks have a whole different picture. They see somebody in this example with credit challenges because they took risks to get here. Then they see a business that's built a credit profile with perfect responsibility, high scores, meaning it's paying its bills on time. A lot of people is giving the business credit. The credit is being used responsibly. And now it changes the picture underwriters have, because the underwriter looks at it just like I described. Well, there's somebody that had problems in the past, and now they built a business and clearly shown that they can build a responsible asset of a business that can manage its obligations. Let's give this person a shot. So this is very important, especially for us to get a business off the ground and start getting the capital that we actually need. So if you're just coming in, give me a shout out. Tell me where you're coming in from and tell me the industry that you're in. So maybe we can talk about some specific financing that works for you in your industry. And this is what we're actually going to be using to leverage to be able to get money. Don't get me wrong. I'm going to give you more ways to leverage to get the money that we need, but we need to get money and we need to paint the picture that lenders want to see to be able to be fundable, to be able to be lendable, to be able to have what they want us to have to be able to lend money. And this is exactly how we're going to do it. So fundability is basically your ability to get funding. It's really what it comes down to. If you want to get money for your business, it's the only place to start. I don't care if you're launching a business or you've been in business 10 years. And I deal with this all the time. I've got friends that have 7-8-figure businesses, a lot of them. And when I talk to them and they run into challenges in getting money, it almost always comes back to one of the issues in this category. So they were able to get some money along the way, higher risk, higher interest rates, shorter terms. And then they try to get better money and then they get denied and they get frustrated and say, I don't know why. And we dig into the basics of how their business is set up. And they just set up the business wrong in the beginning. And that has got worse until it's catastrophic when they actually need funding. And unfortunately, we see thousands, if not tens of thousands of deaths across the world for this exact reason, right? We see businesses structured this way. Businesses are structured with shoddy foundation and things are wrong from the very beginning. And as time goes, then it gets worse and worse and worse. And then all of a sudden catastrophe hits and a lot of people unfortunately lose their lives. It's kind of the same thing in business. You know, in business, if you build the business on a shoddy fundable foundation, then you might be okay. You might be able to get along and maybe get a credit card and maybe get a high risk loan. But as eventually you need to start getting better interest rate, longer term money, that's when catastrophe hits and you start getting denied with no path forward. So we've got to fix this at any stage of our business, or we're not going to be able to set our business up for success and sustainability and funding. Now, there's over 125 points to fundability, too many to be able to go over with you today, but something we call the Fundable Foundation is where you really want to start, and that's just how you set up your business. It's coming in and it's, setting up the right entity type, an LLC or corporation. It's setting up a separate address for the business and a separate phone number for the business, and having a professional email address and a website and a business bank account and a business merchant account, a merchant account to accept credit cards if you could do that. And it also comes down to being able to set up get a license for your business. It's just, these are all the basic credibility aspects of a business, of how a business is viewed by lenders and credit issuers. So this is really one part of fundability. It's the foundation. And in the foundation, there's all those other little parts, right? It's your address, your phone number, your email, and your website. There's a bunch of these 125 that are just in that foundational structure. We got to get this right to be able to have a solid foundation to be able to grow the business on and be able to get funding. Then we look at another part of fundability, and it's business credit reports. Do you have them? What's on there? What's on is your credit scores on there? Is your industry correct on there? Are you seen as high risk because the industry type that you actually have on there? So there's all these aspects. Are you set up with Dun & Bradstreet? Are you set up with Experian? Are you set up with Equifax? Are you set up with CreditSafe? Do you have a BEN number with Experian? Do you have a DUNS number with Dun & Bradstreet? If somebody accesses your credit reports, what does it say about your business? Are you in lawsuits? Are there public records there about you? Do you have accounts that you're paying on as agreed? If you do, how many are those? How much are those credit issuers and lenders giving you? How early are you paying? How late are you paying those bills? Are you in a high-risk industry? How do you compare against other businesses in your industry? All of that information and more is on these business credit reports. And this is what lenders and credit issuers are using it for. So part of our fundability is we got to build out those business credit reports. If we don't do this, then the problem is that we are then relying completely on things like personal credit to pull us through. And by the way, two of the three main reporting agencies in the business world will give you failing credit reports and failing credit scores because you have no credit. And I can show you a lot of these credit reports as example where the risk is about as high a risk as you can get, about a 5 or a 6 on a 100-point scale. So if 1 is the highest risk you can get, business is going out of business, it's about to fail. And 100 means this is as solid financially of a company as you can get. I can show you an endless amount of reports with 5 and 6 scores, about as low as you can get, just because there's no credit established. So we've got to establish business credit. It's a really important part of fundability. If we don't do this, then it's really a big struggle for us to get money. The other thing is personal credit. Look, any guru that's going to come on and talk about business credit or anything else that tries to convince you that personal credit doesn't matter is lying to you. They are 100% lying to you. Personal credit's very important to getting a lot of different kind of financing, especially what you and I want. What we want is long term. We want to pay it back over a long term, and we want a low interest rate. And when we have that beautiful combination of low interest and long term, we have low payments. And low payment means we can borrow more money. So the lower the interest rate, the longer the term, the more money we can borrow and afford to borrow. But we can only do that in a lot of cases with SBA loans, with term loans, with traditional bank loans, with lines of credit, if our personal credit's in order. We've got to get this addressed. And it's an important part of fundability. So the better our personal credit is, the more funding options become available. Now, don't get me wrong. There's plenty of money you can get with your credit being bad. But the problem is, in almost all of those cases you can get it, it still affects your interest rate adversely. It still adversely affects the term that you're given, the rate that you're given. So it still adversely affects your ability to borrow more money and keep your payments low. So again, if our personal credit's damaged, we want to be doing two things. We want to be fixing it while we're building business credit and while we're building out the foundation. Now, we also need to work on financials. Do we have tax returns? Do we have a P&L? Do we have a balance sheet? Now, if I'm financing or a merchant cash advance or credit card stacking or credit line hybrid, any of these kind of things, well, then financials really don't matter. But when we go to get a term loan or go into our bank to get a loan or go to get an SBA loan, they do matter. So remember, there's money you can get now in the beginning part of a business, and there's money you can get down the road, the money we really want to get to, the graduation of where we graduate to that top money that we really want to get. And that stuff's going to look at financials. It's going to look at P&Ls. It's going to look at balance sheets. It's going to look at bank statements. It's going to look at your merchant statements. It's going to look at, for example, your tax returns as well. Do you have a profit? Are you growing? These are kind of things that become very important and a very important pillar of fundability. And we also look at the application process. Are you applying for the right loan program? Are you applying to the right lender? All of these things become really, really important. So even though there's 125 aspects to fundability of what lenders look at, and by the way, I've spent 20 years helping decode this whole thing of figuring out the credit reports they use and the credit scores they use and how they use them and who's sharing information with who and what information are they really looking at for us and what's really getting us denied. And what we found is there's 125 total factors, and they're put into 5 different categories. And these are the 5 different categories that affect how fundable our business is. And it's very important because I oftentimes talk about this foundation a lot. And I oftentimes talk about business credit reports a lot. But I don't talk about these other 3 as much. And you're going to start to see me talk about them more because if you want the best kind of financing, they're the ones that you need to know. And hey, Melissa, thanks for coming in. Well, Melissa from Patterson, New Jersey, trying to get business credit established. I need capital to survive. We're going to talk about that too. I invested to get structured. Now it needs to be financed. Okay, well, that's perfect. And Melissa has a perfect exact scenario of what a lot of us deal with, right? She put her own personal funds in to build the thing. And now she needs it to sustain. She needs it to survive. She needs it to be able to have the cash injection, the business credit, the money into the company to be able to get it to continue where it is until it breaks, until it starts growing. And I don't know about you, Melissa could probably relate to this, but this is what it's like to own a business. You have a great idea. You try to fund it. You get it launched, and it is a nightmare struggle in a lot of cases. It's an uphill fight and battle against all odds. Everybody telling you it's not going to work. Everything you try failing. Everything you think will work, not. Everything you think will not working works. It's like the most backwards experience ever. And what I've learned is the only way through it is forward. You just push, just momentum, momentum, momentum. And then what happens is it pushes you back. You move forward, and then all these obstacles push you back, and you say, I'm with you. I'm just going to keep moving forward. And you just keep pushing until eventually, I call it just breaks. You finally have the breakthrough. You finally find the customers. You find the right marketing message. You find the right market message match. And then things start to happen, and then you start to gain momentum. And that's the way a business is. But to get to that momentum stage, we got to have the capital. And that's exactly what Melissa's talking about. And that's exactly what we're going to be diving into right now. Anthony Williams, Financial Education. I appreciate you coming in. Fort Worth, Texas is in the house. Colorado, Merchandising and Shopping is the house. And we've got somebody from Turo doing Turo work here. Derek Powell is in Tampa, Florida. Derek, we're neighbors here. I'm right down here, Sparkman Wharf. You're probably familiar with Tampa is right here next to me, and right here's the port of Tampa. So you're like my neighbor. Now you know where I am. You got to tell me more info where you are. You're probably right down the street from me. So thanks for coming in. So we've got to start with a fundable foundation. Okay, it makes it easier for lenders and credit issuers to say yes. And what I mean by that is that think about it like this: if I'm applying for money and I don't have revenue and I don't have good personal credit, and I don't have collateral, then what gives a lender security, peace of mind? What makes them look at us and go, man, this person is really going to be a low enough risk to want to lend to? What creates that perception to a lender? That's what a foundation is. The Fundable Foundation says, well, they look legit. Everything checks like it should. And that's what we want to have happen. We want to have a business name that reflects that we're not in a high-risk industry. We want to know what our NAICS code is. We can go to NAICS.com to find the best NAICS code. We want to make sure that NAICS code isn't high risk, and we can Google high-risk NAICS to see that it is. We need to have an address that's separate than our home for our business and not a PO box, like a virtual office, maybe through Alliance, or an actual real location. We have a business phone number. We want to have a website that shows what we do, and an email that's professional, not a Gmail type email address as well. We need to have some numbers. We need to have an EIN number for the business and a DUNS number from Dun & Bradstreet. If we can get a license, we want to get a license. This is a lot of the main components of foundation. And this is where when lenders look, they say, okay, this all makes sense. And more important than all of this is we need congruency. All this information has to be the same everywhere. It's why people get denied. We think that lenders are really scrutinizing these applications to see if we qualify. That's not what happens. What they're doing is scrutinizing the application to see if it's real. You see, banks deal with majority of the applications they get aren't even real. They're fraud. They're people trying to scam the system. They're trying to put through fake businesses to try to get money. So lender, all their security checks initially are just to see if it's real or not. And most of us surprisingly fail those checks. Our Secretary of State data doesn't match our application. Our Facebook page, our Twitter, all of our contact details isn't the same. Our main message of what we do on our LinkedIn profile is different than our website and different than our Facebook. And these lenders' computers get confused because the information doesn't match. They think it's fraud. It's why the majority of applications are turned down. So we got to get this foundation right. The foundation is really the first step to getting money. If we don't do this right, we're either not going to get approved or not get approved for the best terms, or not get approved for as much money as we want, right? So a website isn't just to impress lenders, but prospects look at it online, right? So neglecting your required licensing can mean fines or worse. There's having an EIN in a business bank account makes taxes easier. So these aren't just things you want to do because you want to get money. There are also things you want to do because it's common sense. You know, I don't know about you, but I have not done business with somebody before because they're messaging from a Gmail account. I've looked at their website and that website looks shoddy. Okay. And I'll be honest with you. I'll give you a real circumstance here. So I've got a guy that I talked to this week, and we're thinking about doing some business with this guy. And this business could literally mean about 120 to 150,000 conservatively of money to his business a year. 120 to 50,000 for one client. But you know what? He's not getting my business because his Gmail, he's using a Gmail. His website doesn't really look legit. It doesn't make him look professional. When I'm doing my due diligence check, he isn't passing. And yes, my due diligence check also includes looking at his business credit reports. So that's the problem, is that this stuff isn't just to give you the best perception with lenders and credit issuers. Doing all this stuff the right way is what attracts more customers. It's what keeps you safe with regulatory bodies and stop getting fines or getting shut down. Okay. It's what makes your taxes easier and makes it easier to put more profits in your pocket. So there's secondary benefits of building a strong foundation besides just getting money. It's all these things, from attracting customers to, repelling regulators, to being able to come in and make it just easier to run the business and put more money in our pocket as well. And Chris Brown is in here from Corpus Christi, Texas. Can I get multiple semi trucks and use them as collateral in terms of the equipment financing? Yeah, you can. You can do it. But the more trucks you have, the more probably capital they're going to want down. So what we would do in a situation like this, to give you an example, Chris, is we would actually come in and get equipment financing, and then you should get some other kind of financing as well. Business credit cards, credit line hybrid, other kinds of loans and credit cards, much of which we'll discuss today. And that way that can cover your down payment. So we can get auto or equipment financing to get the trucks. Then we get other financing, credit lines, to be able to cover the down payment for those trucks. So we get in with as little money down as possible. That would be my strategy there. And Australia, Daily Jerk Daily. Thanks for coming in from Australia. Derek Powell. Yes, know exactly where you're at. I'm actually in Riverview area. Okay, Derek, thanks for coming in and saying hi from Riverview. And K.N. Hayes says 3G Business Consulting LLC Social, using Credit Suite to build business. I love that, K.N. Thank you very much for being on with us today. So let's talk about business credit for day-to-day expenses. You use your business credit to buy things your business really needs. And this is one of the biggest mistakes I see a lot of business owners make when they build business credit. When I lay business credit out for them and I say, step 1, fundability, step 2, starter vendor, step 3, retail credit, they just want to move through the steps. And it's not what business credit building is about. The people that are successful in business credit, the ones that join the Millionaires Club, right? And that we have a lot of clients that join the Millionaires Club where they're able to prove that they've secured over $1 million in business credit. Those people that get in the Millionaires Club, not one of them ever has gotten in there that's not getting credit and using it to grow the business. They're not just building credit to get to the next step. They're not going and getting a Uline account and then spending all $50 because that's the minimum they can spend to get it reported. They're looking at Uline and saying, well, Uline sells shipping supplies. They sell envelopes. They sell things that I can mail. So why don't I host a seminar and use Uline to buy all the stuff I need? And that's what they're doing, is they're using business credit to grow their business. And in doing so, they're building their business credit at the same time. And this is very important, because if you don't do this and all you do is the bare minimum, then you're never going to get to Millionaire Club. You're never going to get to the high limits that you want. Nobody's going to give you a $10,000 limit credit card if the most that you've spent on any credit you've been given is $100, $200, $300. And I have those people that will come on the live streams and they'll say, hey, I can't get any credit with the $10,000 high. And my question is high limit. And I said, well, here's my question. What's the highest amount you spent on any account that reports to a reporting agency? And they're like $100, $200. I'm like, well, there's your answer. If you're only spending $100 to $200, and lenders and credit issuers see that, why would anybody give you 10 grand? You're not even using the credit limits you have, so there's no reason to be given more. So we've got to use the credit to be able to buy the stuff that we really need for the business. Not only does that help us buy everything that we need to fund the business, but it also helps prove to lenders and credit issuers that we're going to use the credit if you give it to me. Give me the credit and I'll use it. And then you earn interest and then we'll both win. That's what we're telling credit issuers. But if I show credit issuers, give me credit, I'm not going to use it. I'm going to use the bare minimum. I'm using you just to get a trade line or get an account of credit. They don't want to lend that way. So we've got to be able to use the credit that we're actually getting. And again, this is what I love about business credit. About 85% of most businesses I see, about 85% of what they need to buy, they can use business credit for. So if I sit here on this live stream, I've got my camera right here. I've got a backup camera, a third backup camera. I've got my Dell computer. I've got HP monitors. I don't even know what the story is behind that. I'll figure that out. I got Amazon basic speakers here. I have got keyboard. I've got mouse, right? I've got an Apple phone. You realize that every single thing I just mentioned here can be bought using business credit. I don't need to get a loan. I don't need to get a credit line. What I need to do is get a credit line at Apple. What I need to do is get a credit line at Dell and HP, and a credit line at Amazon, all of which can be obtained fairly easily. And then we're using that to be able to get the money that we actually need to grow our business. It becomes very important. We also need to get and improve the business credit while spending money that we're going to spend anyways. Everybody wants to use a personal credit card because it's easy. We want to use a debit card because it's easy. The other day on a live stream, somebody said, well, isn't it hard to manage spending on multiple credit cards? I'm like, that's why you don't have business credit, because you're thinking about, well, I got to pay off 3 credit cards this month instead of 1. But what you don't realize is that when you only pay off 1, you're only showing lenders and credit issuers that only 1 credit card is what you've ever been issued and that you use, and nobody else wants to give you more. So if you want to be given more, then what you want to do is you want to continue to get more credit and use credit and buy the stuff you would buy anyways. I don't need to use a business credit card to buy these Amazon speakers. I don't need that. I can go buy Amazon speakers. They're like $15. But if I use it on a credit card, then I show other lenders and credit issuers that, hey, if you give me credit, I'm going to use it. I'm going to use it to buy the stuff that I'm using every day. And then they want to give me more money. And that's the picture that we want to paint, that we're giving credit, we use the credit. Okay. The other part of this is that we want to leverage these net 30 terms to buy now and pay later. So when we start building business credit, they give us net 30, net 45, net 15, net 55. And that gives us 15, 30, 45, 55 days to pay back that credit. So what we're really doing is we're buying now and we're paying later. And that helps us grow the business. It's how the biggest businesses all become who they are. I talk about Apple. I talk about Walmart. They're all the same way. Okay, 80% of what Walmart sells on their shelves, they buy with business credit. They use credit to buy it. They put it on the shelves. You give Walmart money. They take your money. They pay off the credit, right? That's how they put all the stuff on the shelves. Then they keep their cash to create and open new locations. It's how all the biggest businesses run. It's why Apple has $100 billion in debt and $120 billion in cash. They accumulate debt and they finance what they can, and they use their cash to be able to expand. And this is what you and I need to do if we want to build successful 6, 7, 8-figure businesses. So we want to be able to get stuff that we need now, use it to make money, then take the money we're making and then pay off the credit that we're accumulating. It's how all the biggest businesses do it. It's how we want to as well. You want to keep your business going even when sales are slow, and business credit's what pulls you through those slow times as well. So there's a lot of reasons that we want to come in, and we want to make sure that we're building and using business credit to be able to establish that we're responsible, and we should be given access to even more credit. And the corporate builder says, hey, the Ghetto Shark Tank is in the house. Thanks so much for all your help. That's awesome. I love that you're considering yourself to be ghetto Shark Tank. I hope that's not me. I could be ghetto Shark Tank too, but I love that. That's so cool. Thanks for coming in and saying hello. And again, tell me where you're coming in from. Give me your business name and I'll give you a shout out here. I always love to spread the word about you and your business. The next thing is we got to leverage business loans for growth. So it's one thing to improve our fundability, and we understand fundability. We understand the 5 components. We understand there's work to be done, and it never stops. It's ongoing. We always want to be working on good P&Ls and good balance sheets and good tax returns and keeping your credit, consumer credit good, keeping our business credit good. We always want to be working on those things because those things, as long as we continue to work on them, continue to make us more and more and more fundable. But we also need to start leveraging business loans. We want to get the money that we need through loans to grow. Okay, and we can purchase lands and buildings through business loans. We can purchase or lease equipment that we need. We can hire employees. We can buy vehicles and use business credit to fuel and service them. So there's a lot of reasons that we need to buy or get money. But first of all, what is the specific reason? So earlier we were talking on here about how we're actually coming in and getting money to buy trucks, right? That was something that we actually just had a discussion about where we're actually coming in and getting the money that we need to buy trucks. And that way, and I'm trying to figure out who that was that we were actually talking to here. Because again, that gives us the ability to grow our business when we're coming in and doing so. Okay, but in order for that to actually work, we've got to make sure, and this was actually Chris. Chris is coming in buying trucks. Well, there's specific financing for that. Chris has learned that. Chris knows, hey, I can get equipment financing for this. I can get auto financing for that truck. I don't need a loan or a credit line. I need a financing specifically for that purpose. A friend reached out, a really high-end influencer in Tampa Bay yesterday, and he said, hey, I got a client, and the client needs money to be able, he needs like a business loan to be able to do this thing with the home, his personal home he wants to do. And I said, no, he doesn't. He needs a mortgage. Like mortgage by definition is using a personal property that property is collateral for the debt. It's exactly what the instrument is used for. So we want to use these instruments for what they're there for, and that frees up money to use for other things. The biggest mistake I see newer entrepreneurs make is they say, I need a $10,000 loan, a $20,000, a $30,000, a $50,000 loan, a $10,000, a $20,000, a $30,000, $40,000, $50,000 credit line. And I say, why do you need a $30,000 credit line? That's absurd. What would you need that money for to start the business? And they say, well, I got to buy computers. I said, why don't you get a business credit card with HP, Apple, or Dell? Well, I don't know, because this is easier. Getting a credit line is easier. It's not easier. It's harder. Getting a credit line for 50 grand is way harder than getting 10 credit cards for 5 grand or 5 credit cards for 10. It's way easier. Let's go the easier path and then get the money that we need to buy the stuff that we need to buy and then get credit lines and loans for the stuff we can't. So an example here is that I can come in and I can use equipment financing or auto financing to get the vehicles that I need on the road, but I can't really hire more employees using a Visa card or, being able to use a gas card or an Apple credit card. I need money for that. So now if I get a loan and I get business credit, well, then that gives me the ability to use the loan or the credit line to flow employees as long as I can, as I get money from the business, as the business starts to make money. And then I have money for specific purposes. Like here, I'm buying vehicles using auto financing, but then I'm being able to fuel them using gas cards. And I service them using gas cards, all of which I can use business credit to be able to do. But then there's other purposes specifically for loans. So there's other loans that we might use to buy real estate. We might get them to buy equipment or buy inventory. If you're an e-commerce entrepreneur, there's credit lines you can get to fund 100% of your inventory. 100% of what you sell on Amazon, you can actually finance or specific financing for that exact purpose. Maybe you have a bunch of inventory and you need to free up capital. Well, you can get a credit line using that inventory as collateral. So there's specialized financing to buy or leverage inventory or equipment or vehicles or real estate. Then there's blanket financing, credit lines, loans we can use for any purpose. So we really need to get financing for the specific things that we need it for, but we still also need to come in and be able to get money overall to be able to fund the stuff we can't, like payroll. So where do we get this money? Well, we get this money by looking at our business strength. There's 3 strengths. There's cash flow, credit, collateral. So when we're in a new stage of a business, we don't have cash flow yet. We're new. Now, the good news is once I have this one thing, cash flow, consistent money, once I've proven that my business concept works, once it breaks and I start making money, 6 months later, a lot of funding options become available. Cash flow financing, where I can leverage that cash flow to get money, merchant cash advances. If I'm running money through PayPal, Square, or Stripe, that's easy financing for us to get. There's credit lines available through Blue Vine. There's Credit Box. All of this stuff about 6 months after generating revenue, all these options start to open up for us. Maybe our strength is credit. Maybe we've got good personal credit. Maybe we don't. Maybe it's bad, but we've got somebody around us that does. My parents are like 860 credit scores. I'm making that up, but I mean, if the highest score you get is 850, they're probably 10 points above that. Like, they're phenomenal. Okay, because they got past the damage I did as a kid, like when they co-signed and I was late and I was struggling and those kind of things. So their credit's exceptional. I've got other friends around me that have exceptional credit, right? I've got investors around me and people that love me enough to have trust in me starting a business that would support me if I want to start a business that would let me leverage their credit. And if I go to my mom, dad, or one of these friends or a potential investor and I say, hey, look, I'm launching a business and here's my idea, here's my plan, here's what my projections are, but I need some capital to get it off the ground. My credit's bad. Can I leverage your credit to be able to get credit lines? It's not going to hurt you unless I don't pay on them, and we can work out something to make sure you know I'm going to pay. And hey, by the way, for helping me out, I'm going to give you 5% interest in the business. I'm going to give you some stock. I'm going to give you 8% return on your money. I'm going to reward you in some way. My mom and dad would never let me reward them to lend money and pay it back. Okay, if I've ever lent money from my parents in the past, which I have, okay, when I was younger, I pay them back 100% of the time. They know I'll pay them back, and they won't accept interest. They won't accept any extra money from me for it. But my friends and investors, I can entice them to invest in me by coming in and using them as a credit partner and giving them ownership interest or giving them an interest return. Now, all of a sudden, I got all these options. I've got 6 months worth of revenue opens up all these options. Now I can get money based on me having good personal credit, or family members or friends, or all these potential, the people that want to invest in me. I can leverage their credit to be able to get money as well. Maybe I have assets that I can leverage. Maybe it is equipment. Maybe it is inventory. Maybe I want to get money financing to buy those things to fund the business. Maybe I have stocks, bonds, 401ks, IRAs. Maybe my mom, dad, potential investor, brother, sister has that kind of stuff they can leverage to be able to get money. So if you think about it, there's more money available for a startup than almost any business segment, really, or just as much, because I can leverage any kind of asset that I have or somebody else has as collateral to get money. I can also leverage my credit to get money. I can leverage somebody else's credit to get money. I can build business credit to get money, or 6 months after proving my concept, I can get money based on cash flow. So there's a lot of different ways to get money. As a matter of fact, if you go to creditsuite.com/27 ways, you'll access our guide on 27 different ways to get money for your business. creditsuite.com/27 ways, 27 ways. And it goes through over 27 different ways that you're actually able to tap in to be the system and be able to get money for your business. Now, what are the best tools to be able to grow then? Because we've got to be able to grow responsibly to be able to get sustainable funding. Well, again, we've got to continue to improve all aspects of fundability. Okay. And you also need to get access to the vastest amount you can get access of business credit vendors. You got to leverage every legitimate funding program that you can get as well. And this is exactly what happens if you are working with Credit Suite. So if we can help you along the way, let us know, because this is our system. You've got to improve that fundability. You got to fix the things that make you fundable. You've also got to be able to access business credit in a step-by-step way where it makes sense, where you're only applying for credit you can get, where you're accessing the largest vetted list of business credit vendors, where you're accessing underwriting guidelines and you know what you can qualify for and what you can't. And at the same time, we also need to have access to funding. Because if I don't have good credit and I don't have cash flow and I don't have collateral, then down the road I will. So I need to get all the money I can get now, and I need to continue to be able to get money in the future. And that's exactly what our finance specialists help you do, is understand the money you can get now and the money you can get in the future as well. So if we can help you through this process, let us know. Now, if you contact us today, we can help you with business growth from startup to sustainability and make every move count. Okay. That way we can help you avoid going down blind alleys and wasting time. And this is why most business owners fail. Look, I see so many entrepreneurs get discouraged because they apply for funding and get denied. But the reality is they never should have been applying for the type of funding they're applying for. And that's, and to me, it's common sense, because I've done it for 20 years. And that's, my friends will come in and they'll say, hey man, I went and applied for this and I got denied. And I go, why would you do that? And they say, oh, Ty, don't get mad at me. I'm like, I'm sorry. It's just so crazy. It's so against what I would have advised you to do. Why did you ask me about it? I thought I could do it on my own and I got denied. Well, here's the good news. You got denied because you applied at the wrong source. You can get the money you need. Let's just direct you over here, and this is going to help you. I talk to these people all the time. They call in, they have this exact issue, but you don't want to go down that blind alley. You want to know the money you can apply for and get approved. You want to only apply for money you can get approved. You want to set up your business where it's appealing to lenders, where they want to lend you money, and you want to be focusing on the financing you can get, not wasting time on all the sources of funding that you're just not able to get. So again, if we can help you along the way, a couple things to do to be able to get started. First of all, give us a call for a free consult or go to creditsuite.com/consult. With us, you get a free finance assessment that does three things. We'll look at your fundability, see what's wrong, and give you advice on what to do to fix it. We'll help you, give you tips and tactics to build your business credit. If you even think it is built, we'll get your credit reports for free, go over those with you, and tell you what you need to work on to continue building business credit. And we'll do a finance assessment to tell you exactly the money you are able to qualify for right now. All that's 100% free on an assessment with us. You can give us a call or schedule at creditsuite.com/consult. And I didn't have a lot of time to dive into fundability today, but if you go to creditsuite.com/foundation, you can actually grab our free mini course, and our mini course walks you through the exact steps that you need to take to set up that business where you're actually fundable. So make sure you take those steps as well. And let me get some shout outs here, because I know we've got some new people in the house. Okay, and Blanca says, Credit Suite, I'm probably needing the most basic startup help. Signed up with merchandising shopping companies. My aim is to build this as a business. I'm needing help with the start process. Then this is perfect. Blanca, let us know if we can help you, because that's exactly what we do. Is with us and our system, we literally come in and help you from the ground up to actually be able to come in and set up the business, structure the business properly, start getting your fundable foundation established, and then immediately start getting business credit, which you're able to use for this purpose. And hopefully the tips that we talked about today will help you as well. And to be seen as legitimate business phone, email, all these type of things. Okay, so look, and most is being able to obtain a vehicle to be mobile for my business. That's very easy to do. So actually, surprisingly, Blanca's talking about a really real problem. I'm starting the business. This is what I need. The asset I need is a vehicle. How do I get it? Well, the great news is that if you start building business credit, well, it's different. If you do it on your own, it could take years. If you're working with our system, then in about 6 months' time, you can get to the final tier of business credit building, which is universal credit, Visa, MasterCard, and it's also auto financing without a guarantee or credit check. An example, one of our clients, Christine, got $185,000 financed at Ford without a personal guarantee, without a personal credit check. I was with my videographer today. We just did a whole video on how to get a Ford financing to buy an actual work truck from Ford. So that's very obtainable. All you have to do is be able to come in and build your business credit to get there. Give us a call. We'll give you free tips and tactics to be able to help make that happen, and talk about a faster path to make it happen as well. Okay, and our Diamond Cole says, hey, Louisiana, PG1services.com. Thanks for coming in. Appreciate it. And we've got Chris Griffin from Oklahoma is in the house as well. Melissa, hey, I'm needed the free consult. Okay, well, let me give you a call. Right here's how you get it. You can go to creditsuite.com/consult. You can email us or you can call us, and we will definitely make sure you get that free finance assessment. Speaking of free, if you got value from this training, go to creditsuite.com/toolbox. I'm giving away about $400 worth of free, really cool resources that will help you build your business credit, obtain loans and financing. All you need to do to get it is you just need to go to creditsuite.com/toolbox and share our next stream. At this link, it'll tell you exactly what to do. You share our next stream to help other entrepreneurs, and you get about $400 worth of free resources that will help you get the money that you need. Look, if you got value from this training, visit creditsuite.com, like and subscribe on our social channels. It takes less than 1 minute, and this is a longer training. We have short videos. We have 1-minute training, all dedicated to helping you get the money that you need. And then make sure you also keep your eye out for our next training, where we talk about more cool ways to get the money you need to start and grow your business. Thank you very much for tuning in. Don't forget to give us a call for your free finance assessment so we can help you fix your fundability and get business credit and be able to access the loans or credit lines you deserve and need to be able to start and grow your business. So thanks for tuning in.